Let's talk about recent changes to UK fiscal legislation and some changes which are likely to occur in the near future, in the short and medium term. So this particular video is relevant for expatriates and long-term foreign residents. So I'm a long-term foreign resident. I've been living in Brazil for quite a long time, for over a decade. An expatriate, I know people use that word interchangeably, but when I use it for the sake of financial planning, an expat is usually an individual who is on a finite contract, usually with a multinational, with certain benefits like their accommodation paid for or tax-free salary components. Sometimes their children's education is covered by their company. So that's where I use the word expat for the purposes of financial planning. A disclaimer, we're going to talk generally about financial and tax planning. We're not providing capital markets advice. Let's be really clear about that. That's covered in other videos in our channel anyway, but just thought I'd clarify that. So let's move on to some of the fiscal changes in the UK. I have to say I find myself sympathising with many workers and savers in the UK. Tax rates seem to be going up in most countries around the world. It's a reality which we all have to face and plan for. In the UK, it's been particularly strong in recent budgets and mini budgets, many of which are not that mini when it comes to the actual changes proposed in them. Let's consider some of the issues which are facing British citizens who maintain financial exposure to the UK, and many of whom intend to return to the UK, either to work for specific periods or to retire. I mean, I know a lot of Brits abroad who are planning to live overseas till they're 55, 60 or beyond, and then eventually return. There are a number of reasons. Sometimes it's family ties, sometimes it's health, sometimes it's saudade, a word in Portuguese, in Brazilian Portuguese, which is really means they're missing it, they're longing for it to return back to their roots. Whatever the case, a really important change in the UK landscape is the state pension age, the SPA, and this is likely to rise to 71. Now this was 66, and it was already confirmed that it would increase to 68. So the state pension age is when you can start receiving your state pension. Yeah, and this is, it's a solid pension, it's robust, it's backed by the UK government, and it's, it was already proposed it would go up to 68, but it's now likely to increase to 71 for anyone born after 1970, April 1970. This is driven by falling birth rates and rising life expectancies, and the government, simply can't finance that, but it is making it very, very difficult for people who are relying fully or relying largely on the state pension. In terms of British citizens overseas, it may affect some of their decision making in relation to whether they continue making voluntary national insurance contributions. Bear in mind they're based overseas, they're working overseas, so their NICs will be voluntary. And it may also change people's attitudes towards whether it's worth making up any gaps in their national insurance record. Some people may say, you know what, it's not worth it if it's going to kick in from 71 for anyone born after 1970. And then some people do appreciate the inflation proofing, the triple lock, which you can read more of. I've put that in the comments here in the description of the video. But there's some really good inflation proofing of the state pension. But how long will that last? There was talk at one point during the pandemic as to whether the triple lock was actually a sustainable feature or whether they should waive it for 1 or 2 years. Given the likely increase of the SPA to 71, it should really highlight the importance of saving privately, making private pension arrangements in a tax-efficient manner. And that's a little bit more challenging when you're an expat, if you're moving from country to country every 3 or 4 years. Let's say you're with an oil company, and even if you're a long-term foreign resident, let's say in Brazil or Colombia, wherever, if you're there for like 10 or 20 years, you still have to understand how to be tax efficient in your country of citizenship, which in this case is the UK, and in your country of residence, which could be Brazil or Colombia. So it's good to take advice in both jurisdictions. Now let's talk about good old CGT, capital gains tax. And this applies if you're holding a UK-based general investment account. In summary, for investments, basic rate taxpayers in the UK pay 10% on realised gains. Higher rate taxpayers pay 20% on realised gains. Prior to April last year, so tax year 2022 to 23, the allowance for realised gains was set at 12k. So you could sell up to 12k, and then anything above that is taxed at 10 or 20% based on what rate taxpayer you are. For this current tax year, 23 to 24, that went down to 6k. So from 12k to 6k, which means that you've got less room for manoeuvre. And you've got even less room for manoeuvre next year from April. So when I say next year, I mean from April this year. So the next tax year, 2024 to 2025, and it's going down to 3k. So in just over 12 calendar months, it would have gone down from 12k to 3k. Wow. And let's move on to dividends. Again, this applies if you are holding a UK-based investment account, including an ISA. This allowance has gone down from 2,000 in tax year 22 to 23 to 1,000 in this current tax year, 23 to 24, and it's going down to 500. I really can't believe this. £500. That's the dividend allowance after April in tax year 24-25. It's unbelievable. If you are a Brazilian tax resident, you may or may not be liable for tax on overseas dividends, and this depends on the aggregate value of your dividends and your aggregate earnings in Brazil and overseas. That will determine how much tax you pay. You need to keep an eye out, given that you may be earning dividends from, say, shares or ETFs, and what was not taxable, say, a couple of years ago when the tax-free dividend allowance was 2,000, it could breach the new cap, which is set at £500 from April this year in tax year 24-25. So if you have got dividend earnings, which were, let's say, 1,500, they were not taxable before April 2023. They could be taxable now. Well, they will be taxable after April 2024 in the next tax year. So keep an eye out for that. And finally, I was thinking about adding IHT, inheritance tax, to this video, but no, I think I will record another video for that. I mean, don't even get me started on how the 325k allowance has been frozen until 2026 and is likely to be frozen for another 2 years to 2028. So this is in a period of high inflation. So yeah, these stealth taxes are affecting a lot of people, but I think I will prepare for another video. In the meanwhile, take care of yourselves and your financial planning. Ciao.